The importance of credit score in the US is that it can affect your life in many ways. For instance, if you want to buy a house or car, then you might need a good credit rating. A bad rating will not only make it difficult for you to get loans but also increase the interest rates on those loans. The higher the rating, the better are your chances of getting lower interest rate products and services from various companies. If you have high rating, then they are more likely to lend money at favorable terms because they know that they will be able to recover their investment by collecting interest payments over time. If someone has low rating though, lenders are less willing to offer them any financial assistance with their needs even if what they need is a small amount of money. People with low rating usually have to pay a much higher interest rate for any type of loan that they take from their financial institutions. In addition, the rating agencies also determine if you are eligible for credit card or not. They calculate your ability to pay back the money that you owe and provide an opinion about it based on your income level, age, existing debts, etc. In other words, people with higher ratings get better offers while those with lower scores get worse offers. Even though we live in modern times where almost every aspect of our lives is controlled by computers and credit rating agencies estimate your score based on your past history and current behavior, there still seems like always room for errors and inconsistencies since there is no system that is perfect and flawless in this world. If you do business with other companies, then they might check your rating to see if it's good or not before offering their products and services to you. If the score is low, then your requests for better rates will be ignored or rejected. This can make a huge difference in the prices of goods and services that you receive from these companies because higher interest rates translate into higher prices at the end of the day when you buy something through installment plans. It also makes it harder for you to get lower price if there is a competitor who offers them under specific terms which you cannot obtain. To summarize all above: 1. The importance of credit score in the US is huge because it can make a difference between success and failure when you apply for loans, get lower interest rates on them, etc. 2. It can affect your daily life to a great extent since almost every company checks your rating before providing their products or services to you. You might have to pay much higher prices if your rating is low, just like lower interest rates if it's high. 3. In addition to being able to afford better price when buying something from an institution that provides installment plans, people with high ratings also have more opportunities, example, job offers, business deals, etc. 4. Your chances of getting a favorable judgment in a court case are also higher if you have a good credit score. 5. Lenders are usually more interested in giving money to people who can repay it back on time because that's how they make profits. Credit rating agencies help lenders by estimating the ability of the borrower to pay back the loan. 6. The importance of credit score is not only for individuals but also for businesses because it reflects their trustworthiness and creditworthiness. In other words, if your rating is bad, then you will find it difficult to do business with other companies due to high interest rates and other penalties that they might impose on you. 7. Credit score is important because it helps financial institutions avoid risks by lending money to people who are likely to repay it back. This way they do not lose money by giving out loans to people who cannot afford it, and the risk of losing money through defaults is minimized. 8. Last but not least, there's no need for you to worry about credit score unless you want to apply for a loan, get a lower interest rates on them, and avoid paying higher prices or receiving worse services, etc. Nothing else matters as much as this. Credit scores are often used by companies, such as auto dealerships, banks, mortgage lenders, and others involved with lending money, to help determine whether someone will be approved for financing or how high their interest rate might be if approved. It can also affect daily life because there are many companies that check credit scores before providing products or services. People with low ratings might have to pay more for items bought on installment plans, receive higher interest rates from banks, and be at a disadvantage when competing for jobs or business deals. Your credit score is also taken into account when you go to court. If you're involved in a lawsuit, the person suing you can ask the court to order you to disclose your credit score. Your credit score could also be used by the judge to help decide the outcome of the case. For example, if someone doesn't repay a debt, the creditor may go to court to try to get a judgment against the debtor. The credit score could be used evidence to show that the debtor isn't able to pay the debt. Lenders are more likely to provide financing if your credit score is high. They use it as an indicator of whether you will repay the loan or not. Credit scores also help financial institutions avoid risks by screening out borrowers considered to be high risk, thereby minimizing their exposure to losses through defaults on loans. The importance of credit score is not only for individuals but also for businesses because it reflects their trustworthiness and creditworthiness that lenders require in order to approve them for small business finance or large corporate loans that might otherwise not qualify given the business' weak financial position. Lenders rely heavily on all types of credit history information when assessing applications for unsecured personal loans, mortgages, car loans, or other types of credit products. There are a few things you can do to improve your credit score if it is low. One way is to start making small payments on time for all the bills that you owe, such as your credit card, student loans, car loans, and others. You should also avoid taking out new loans or using your credit cards if you can't afford to pay them back right away. Finally, make sure that the information in your credit report is correct by checking it regularly for mistakes. Dispute any errors you find so they can be corrected. Credit scores are important because they reflect how responsible someone has been with their finances in the past. A high credit score means that a person has been able to repay their debts on time and has not missed any payments. Someone with a low credit score may have a hard time getting loans in the future or paying higher interest rates. There are a number of other things you can do to help improve your score over time, such as paying off debt and limiting new purchases on your credit cards. It might take some time for your score to go up, but continuing to make responsible decisions with your money will eventually pay off in the long term. Credit scores are significant because they determine whether you get approved when applying for loans from banks, finance companies, etc., how much money you'll be lent if approved by these institutions, what interest rate you pay on that loan if you are approved, whether you can rent an apartment, whether you'll be hired for a job, and how much you'll have to pay in interest on that loan to buy a home. A low credit score could indicate that a person has trouble paying back what they owe, but it doesn't mean they don't have the money available. A good credit score does not require large amounts of income or assets. Your credit score is calculated based on your financial history, which includes information from your credit report or past borrowing activities such as how often bills were paid late and any bankruptcies, foreclosures, or tax liens. In many cases, lenders use other types of information in addition to your credit score to make a lending decision. This includes your income, how long you have been employed, and the amount of money you have in savings. Your credit score is important because it reflects how responsible you have been with your finances in the past. A high credit score means that you have been able to repay your debts on time and have not missed any payments. A low credit score may mean that you have a hard time getting loans in the future or paying higher interest rates. There are a few things you can do to improve your credit score if it is low, such as starting to make small payments on time for all of the bills that you owe, avoiding taking out new loans if you can't afford to pay them back right away. The importance of credit score in the United States is multifaceted. Your credit score reflects how responsible you have been with your finances, and it can determine whether you get approved for loans, what interest rate you pay on that loan if approved by lenders, whether or not you'll be hired for a job, and more. To improve your credit score over time, there are some ways to do so, such as paying off debt or limiting new purchases on your credit cards. It might take some time before your earnings go up, but continue making responsibly decisions with money will eventually pay off in the long term.